The IRS didn't send you a letter. They didn't run a commercial. They didn't call your phone. But in 2026, 4 tax rules that directly affect your retirement income changed. And a few of them could put real money back in your pocket this year if you know where to look. My name is Eduardo, and what I do on this channel is take the stuff buried in government fine print and translate it into plain English for people who are actually living in retirement right now. Before we go any further, I am not a lawyer. I am not a CPA. And nothing I say today is personal tax advice. What I am is someone who pays very close attention to these rules so you don't have to do it alone. Always confirm what you hear today with a qualified tax professional who can look at your actual numbers. Now, let's talk about what changed and what it means for you. Change number 1. The senior bonus deduction. The first change is the one I want you to write down right now because it is brand new and most people have never even heard the name of it. It is called the senior bonus deduction. Starting with the 2025 tax year and running through 2028, if you are 65 or older by December 31st, you automatically qualify for an extra $6,000 deduction on top of everything else you already get, just for being 65. That is it. No receipts, no itemizing, no complicated paperwork. You qualify, you get it. And if you are married and both of you are 65 or older, that is $6,000 each, $12,000 total knocked right off your taxable income. Now here is the part I really need you to hear. This is not the regular standard deduction. This is not the small extra amount seniors have always gotten for being over 65. This is a third completely separate deduction that stacks on top of both of those. It shows up on a brand new form called Schedule 1A, a form that literally did not exist on your tax return 2 years ago. And that is exactly the problem. If your tax preparer is moving fast, if your software doesn't flag it, that form doesn't get filled out. And you never see the $6,000 you were owed. This is the year to ask your preparer directly. Did you include the senior bonus deduction on Schedule 1A? If they pause, that pause is worth money. One catch. And there is always a catch. This deduction starts to shrink once your income goes above $75,000 for a single filer or $150,000 for a married couple. It phases out gradually and disappears completely at $175,000 single or $250,000 married. If your income sits near those lines, you need to know exactly where you land. Change number 2. How much you can shield from tax. Altogether. This one builds directly on what we just covered, so stay with me. For 2026, here is what a single person over 65 can now stack up in deductions before the government is allowed to tax even $1 of their income. $1,100. The basic standard deduction. Roughly $2,000. The long-standing extra amount for being over 65, $6,000. The new senior bonus deduction add that up. A single retiree over 65 can now shield roughly $24,000 of income from federal tax before doing anything clever or complicated. For a married couple where both spouses are over 65, you stack all 3 layers twice. We are talking somewhere around $47,000 of income sitting completely outside the reach of federal taxes. Why does this matter so much for retirees specifically? Because a huge number of people living on Social Security, a pension, or a modest retirement account have total incomes that fall right around those numbers. And when your taxable income drops low enough, something else quietly happens. Part of your Social Security may stop being taxed at all, simply because your taxable income fell below the threshold where that kicks in. That is real money, recurring, year after year. And nobody mailed you a flyer about it. Change number 3. The state and local tax cap. This is the change that got the most attention in the news, so I want to be very straight with you about who it actually helps and who it doesn't. For years, there was a hard cap on how much you could deduct for state and local taxes, things like your property tax and state income tax. That cap was frozen at $10,000. Didn't matter if you paid twice that. $10,000 was the ceiling. Starting in 2025, that cap jumped all the way up to $4,400. On paper, that sounds like a massive win. But here is the honest truth. That bigger cap only helps you if you itemize your deductions. And itemizing only makes sense if your total itemized deductions beat your standard deduction. Remember that $47,000 stack we just talked about for a married couple over 65? Unless your property taxes, state income taxes, mortgage interest, and charitable giving all add up to more than $47,000, you are still better off taking the standard deduction, and this cap change never touches your life by a single penny. So who does it actually help? Retirees in high-tax states, New Jersey, New York, California, Illinois, who are still paying significant state income tax on a pension or investment income, and who own a home with a large property tax bill. For those folks, this change is genuinely significant. For everyone else, take the standard deduction and don't give this one another thought. Same rule. Completely different outcome depending on who you are. That is why you cannot just hear a headline and assume it applies to you. Change. Number 4. The estate tax exemption. This last one is quieter, but it lifts a fear that a lot of retirees have been carrying around for years. There was a lot of noise about the federal estate tax exemption getting cut nearly in half. Estate attorneys were telling people to hurry, restructure, gift assets before some deadline hit. Well, that deadline came and went, and the opposite happened. The higher exemption was made permanent and raised. In 2026, you can now pass roughly $15 million per person, or $30 million for a married couple, before the federal estate tax touches a single dollar. For the overwhelming majority of people watching this, federal estate tax is simply off the table. You do not need to lose sleep over it. But, and this is important, your state might be a different story. Several states have their own estate or inheritance tax, and some of them kick in at just $1 or $2 million. A paid-off home plus a lifetime of savings can quietly cross that line. The federal door is closed. Check whether your state left a window open. And the thing I really want you to walk away with today, it is called the step-up in basis, and it is one of the most powerful and least talked about gifts in the entire tax code. When you leave your home or investments to your children at death, the value resets to whatever it is worth on the day you pass. Decades of growth, wiped clean for tax purposes. Your child sells the house and owes little to nothing in capital gains. But if you sign that house over to your child while you are still alive, trying to be helpful, trying to simplify things, they inherit your original purchase price instead. And when they sell, they could owe capital gains tax on every dollar of growth. One well-meaning decision at the kitchen table can cost your family tens of thousands of dollars. Do not give away the house early. Talk to a professional first. 4 changes, all of them technically public. None of them explained to you directly. The system will work very hard to collect what you owe it. It is in no rush at all to hand you what it owes you. That gap between what you are entitled to and what you actually claim is one of the most expensive gaps in retirement. And it exists for one reason. Nobody sat you down and explained it. Now somebody did. If this helped you today, share it with one person over 60 who is about to file their taxes this year. That one share could be worth real money to someone you love. I'll see you in the next one.